find that at the core, Pick n Pay actually exceeded Shoprite's growth by 1% in South Africa. And that, I think, is probably a driver of what caused the share to rally from its lows to close still down, but much higher than the lows, because there had been a lot of concern. I even began to doubt some of my own thoughts, considering some of the recent data that came out that was from Asked. It's a data provider covering the local sectors, that had shown that the core P&P brand, those stores, had been a bit sluggish in recent times. And when we saw what Shoprite had done, we also built a narrative that it's likely that Pick n Pay were a net loser of what is a Shoprite versus Woolies battle. It doesn't seem to be the case. It seems that even if because we don't have the detail, but even if it is the case that P&P brand is struggling, the Boxer brand seemingly is more than making up for it. And the numbers that I'm quoting are also excluding clothing. So Pick n Pay also is gaining share in clothing, but that broad category is not delivering the kind of growth that food is delivering. Nonetheless, it is excluded, and the performance is not necessarily because of clothing. I think it ended up coming down predominantly to Boxer. And I think that therein lies the point for me broadly. We can see what Boxer can do. It is still an uphill battle, because I think that Boxer benefits from hard lockdown, and we're not there anymore, and we can see the Shoprite brand, which is more a brand that caters to people that moves about because it's closer to transport nodes. So a more open economy does favor the likes of a Shoprite brand as opposed to a Boxer brand. But Boxer can probably retain a lot of the sales and share that it has gained. They just need to actually accelerate. They're only opening up about 25 stores. Just anecdotally, in Cape Town, there's like 3 Boxers, which is supposed to be a stronghold for Pick n Pay, being a Cape Town company. And I think that they need to move more quickly and to harness an opportunity that is there, because the lower end Boxer brand can actually deliver a better margin for the group, and that's what can contribute to a positive surprise potentially in some of the quantum of earnings growth, because of the extent of margin improvement from a mix perspective, store mix perspective. The core Pick n Pay brand is always going to battle to be competitive, whilst all of the cost savings that they're delivering is going to be eaten up by them trying to be competitive. And that is essentially the story as it stands right now. I don't think clothing is going to be a big, catalyst in any way or form. It does contribute positively, accretive from an earnings growth perspective as they gain share, because it does have higher margins in the order of 10% versus 3% at a group level. But it's, by our calculation, only 6 or 7% of total SA sales. Boxer, on the other hand, is closer to 20%, and therein lies where they can really step change. Boxer has probably 5 or 6% margin compared to the group average. That's closer to the likes of what Shoprite is delivering, and Shoprite delivers that for 2 reasons. One, it has about 40 to 50% of its store base is in the discounter section, the Shoprite and Usave brands combined, which offer higher margins because of lower costs, more private label and the like. And also because Shoprite has less by way of franchise. 15% of its store base is franchise, whereas with Pick n Pay, 40% of its store base is franchise. So there are some structural things that explain the margin differential. But when you do look through it, there's no doubt that the kind of cost savings that the company is seemingly continuing to deliver, including Section 189 retrenchments over and above voluntary retrenchments, it speaks to the extent of cost cutting that needs to take place. Supply chain efficiencies are credibly coming through to help support, through reinvestment into price, the competitive that the group needs. But margin improvement is the end game. It's mostly going to be through mix, and this is what we need to continue to see from the company. Yesterday, I said that I had forecast unchanged earnings. Actually, I was mistaken. It was for this year. It was that I had 12% down. So they're actually with a range of 0 to 10% down. actually a little bit better than I was expecting, and I think it really, the top line probably explains all of that. They were ahead of my estimates, well ahead of my estimates. I was expecting like-for-like volumes in South Africa to actually decline in the second half. They actually increased by 4%. And that's the key number that I think that through the course of today and as we hear eventually from them, that the market will react to. The share has upside over and above my thematic that I think you should be in the quality defensives. And Pick n Pay also, the cost savings must still annualize fully, especially in terms of the one-offs that relate to those cost savings. Retrenchment wise, those will go out the base, and so Pick n Pay can deliver in excess of 20% growth, which is ahead of the likes of Shoprite. But given all of what I've mentioned, I think that you understand there's potentially still a lot of risk as the likes of Shoprite and Woolies, for that matter, also push back in an ongoing battle there in that space. We had a 12-month target price of 64 Rand a share and an outperform rating, which we sitting more comfortably with, having not been so a little while ago before yesterday. Thank you.